Welcome to episode 6 of Compounding Brothers. How are you, my friend?
Good, Joaquin. How are you?
I'm good,
It's been a
Paul.
while since we did episode 5, but it's been a lot going on too.
A lot of things going on professionally, personally for both of us, but it's great that we managed to coincide before the end of the year. I know you have a busy schedule, and I'm very grateful of being able to run this last episode of the year with you.
It's fun.
Yeah. So always the disclaimer, everything that Paul and I discuss here is only for informational and entertainment purposes only. Consult your guru, your psychic, your psychologist before making any investments, or even your financial advisor. Nothing of what we say here is to be construed as financial or professional advice. I can see you having fun. Tell me everything about this.
Well, this was we had a long weekend in Peru, so I had never been to the second biggest city in Peru, which was Arequipa, and it's a colonial city. It dates back to the 1500s, late
Wow.
1500s. And so we had a great time, and my wife and I were carrying some alpacas there. The two other photos are in a monastery that dates back, I think, to 1560 or 1570, and it was silent. It was for nuns, and they always had to keep silence, which is why it says silencio on it. But it's a beautiful city. The architecture is wonderful.
What is that well that you are showing us in the middle?
Oh yeah, it's in the middle of a kitchen where the nuns used to cook, and that well was where they used to get water. And apparently, if you throw a coin, it's supposed to be good luck.
There you are. So you're throwing the coins there. I get it.
Yeah, so we threw the coins, but I think we already had our good luck with the gold miners and the lithium miners.
Yeah, absolutely. We're going to be touching on that. I'm so glad that you had that long weekend. It's great. Looks great. So we also had a blast. I took my two boys to Trump International in Palm Beach to an auto exhibition, and Axel especially likes supercars. So there you see the Lamborghinis and the Bugattis, and in the back, there were as many Ferraris I cannot count. I mean, and it was a great evening, and they loved it. And then we spent a few days in the Space Coast. You see the full family there in the top left, and it's really. I mean, I had gone there many years ago, and it's a really good place to go with kids. It has improved dramatically. We had a meet and greet with a real astronaut who flew 5 space missions and stayed in the Russian Mir space station, the first American to join the Russians for 3 months. So, and this guy is like 80 years old and is like sharp as a tack, and he answered questions the kid asked him, so it's great. And then you see us there with an astronaut, pretend astronaut, and then the kids with their trophies after the Christmas concert. The three you can see there play the piano, and then we celebrated Maya's birthday on the right hand side. So it was a lot of fun in the last few weeks.
Oh wow!
Yeah,
Great.
fun. Yeah, family's been great, and that's the most important thing. So, as we always do, we like to keep score. These are the very same 6 themes that Paul and I introduced since episode 1, like 8 months ago. And those are the returns as of now, and then the annualized returns. And we're talking about the tech new picks and shovels at 60% annualized. Solar and batteries at 180% annualized. Miners at 113% annualized. Housing sensitive stocks, this has not even started, at 64. the China, what we call the China jewels at 41, and emerging markets diversified at 11. The Cinderella of the story is, and I were just talking about this, right? Paradoxically, it's probably the area I'm the most excited about.
Me too. It's really a head scratcher why we haven't made more headway on the returns on this part of the thesis. But hey, sometimes it we have to wait things out until people catch on.
I think that there is a confluence of forces that are going to self correct in due time. I think there's still up until recently many basins that are going to become relatively or strong decliners in oil production that produce natural gas as a byproduct. One of the interesting things is that when you are going past 50% of production, the composition of natural gas of those declining wells becomes way higher in natural gas because of the physics and the geology of the wells. As the pressure starts to decline, it becomes higher composition of natural gas. Then you have a lot of investment that couldn't find yet its funnel through the export channel because of the Biden prohibition in the last 2 years of the Biden administration of new LNG terminals. Those things are coming online fast, and that's going to continue next year. And then you have all the build up of data centers that is just starting because most of these things are being built. Most of the investments that people talk every day in Bubble Vision, those things are going to start to be built or are being built as we speak, and they're going to come online in the next few months. So all those things converge to supply becoming more risky and demand more stable, and that's what's conducive to higher prices. So we're very close to start seeing natural gas move consistently higher. It moved higher until 2-3 weeks ago. It was probably the best performer of many commodities, and then it had this decline in the last few weeks.
Maybe pinpoint a reason as to why we haven't seen our expectations materialize yet. Yet being the key word is the oil market has been clearly in a glut, and I think and it seems to be worsening as we keep getting increased capacity that's coming online out of Guyana, for example. I think there is a number out there that says if Mexico can start making some improvements into the mafias that are controlling some of the oil transport, and if Maduro exit the stage, in the Americas, along with Vaca Muerta, we could have just 10 million barrels a day of additional production come on stream just in the Americas. Mm-hmm. So I think people are very concerned about this glut. What I've just said, I think, is very common knowledge, which means it's incorporated into the price. It's weighs heavy on sentiment, and I think that's sort of playing into nat gas being down relatively to what we think it should be, especially the equities that we've named, which are first quartile cost of production producers. So I think it's a matter of time.
I think it is. I'm very bullish on natural gas, but I'm not bearish on oil at all. And when people start talking about all these theories about supply and demand and the IEA and saying that demand is going to be such and such, and that's explaining, I mean, there's nothing more physical and tangible than oil. Oil is produced and consumed. So you can make all the theories you want, but if prices are going down today, it's because supply is is above demand. And if prices start to go up, it's because, I mean, you can make all the theories you want about contango, backwardation, but at the end of the day, the price settles where supply crosses demand. I think what's going to end up happening is we're going to have a reacceleration in growth. There's been a huge, massive underinvestment in oil, despite Guyana, despite Mexico, and despite everything else. So if you think in terms of the oil deficit that you have between now and 2050, it's massive. I'm not bearish at all on oil, but if I were to bet in the energy space, I wouldn't bother to be concerned with oil because naturally it has significantly more tailwinds and more reasons to be bullish without making too much of a guess as we might need to do with oil. So
That's right, and there's always one code I live by, which is invest in what's most hated. Odds are you're you're probably not going to lose a heck of a lot of money, and you'll stand to probably make a lot of money. And energy is one sector that is absolutely hated. And like I said, the statistics I pointed out are widely known, and
yeah,
I kind of like that because that kind of gauges where sentiment is. And also, when you look at the charts we're going to show, where what how much of the S&P is energy nowadays, you can see that it's very much hated,
yeah.
which is where you should be positioning. We just have a preference for nat gas and the cheap producers of nat gas at that.
Yep. Agreed. So this page is along the same lines of many similar pages that we've shown across all of our episodes. What you have here is the subsequent annualized return on the S&P 500 as a function of the forward price earnings ratio. And I don't know if you can see the red dot, but the red dot in that page is where we are at now, and at current valuations for the S&P 500. If history is any guide, we're looking at negative expected returns in the subsequent 10 years. So between 2025 and 2035, we're not saying that the stock market is going to crash or that it's going to be down tomorrow or the day after. I don't have the faintest idea what the stock market is going to do in the next 3 months or even in the next year. But it's very risky to put, as many people passively do today, many retirees, many savers in 401ks, in pension plans, to put their nest eggs in this basket because you're almost guaranteeing negative returns for the next 10 years, especially when there are easy, like low hanging fruit ways to diversify your assets into sectors that protect from what are today very high valuations.
Uh, it, you just, if I had to put what you just said in a nutshell, is look at the pie, and then there's slices of that pie that are very expensive, and there was ones that are very cheap.
Mm-hmm.
You don't have to suffer making negative real returns over 10 years. If you know where to look and know where to invest, you can basically pick those cherries from the pie that are very cheap, and you will actually have very good risk-adjusted rates of return. Because if you're buying something cheap, it's a lot less risky than buying something very expensive. So
100%. And this page makes the case you just made. It makes it for you. Uh, Look at that chart on the top left
yeah,
hand side of the chart, and what they did there is they ordered all the companies in the Standard & Poor 500 in groups of 100 just based on size. Starting from the top 10, and then the top 10, they put as a separate bar, and then 1 through 100 largest, 101 to 200 largest, and so on and so forth. And when I saw this chart, I thought to myself, this is probably the most important chart I'm going to see in this entire month, at least, because it's telling you how Jack Bogle went wrong. It's telling you how passive indexing, taken to an extreme, created this monster of overvaluation in the largest, highest capitalized companies in the Standard & Poor. So if you start with the top 10 companies are trading at 27 times earnings. If you look at the next tranche, the 1 through 100 are trading at 23, and so on through, as you were saying, there are layers trading at under 15 times earnings simply because they are smaller. So mechanically, what's going on, and you and I have discussed this repeatedly, mechanically, structurally, passive investors pour their money into index funds, and the money goes in proportion to the size of the companies. So the largest companies takes up disproportionately high percentage of those new dollars, increasing their valuation, increasing their prices, driving more market cap, creating this positive feedback loop by which in the next cycle they get even more dollars, creating momentum, creating beta, and then you have this concentration among 100 companies that are trading at extreme valuations.
Yeah, so there's, in this top 10 companies, what you're doing is it's the same thing as, I want to pay more. Then the other guy says, no, I'm going to pay more. Then I'm going to pay more. So you end up having this race to pay more for an ever smaller amount of companies, which take most of the allocation that goes into an index fund. It's gotten to be very perverse. But it's, we thank God for them, because that's actually creating some great opportunities for us who are looking at companies in the mid cap, small cap space, value, which is where some, really good investments, really good companies lie. So
the issue that I have is that when this process goes in reverse, it can happen very quickly and it can be very nasty. And sometimes when these things adjust, they don't adjust slowly. They adjust sometimes very suddenly. The takeaway I want people to draw from this chart and from this analysis is that when you buy the index, you are buying a hidden factor. You think you're buying a diversified basket of 500 companies, but you are not. In reality, we know that only a few companies account for, like 10 companies account for 40% of the market capitalization of the index, which is an absurd concentration. But the hidden factor you are buying is called low expected returns. And when we say low expected returns, we're saying negative expected returns. So, and the interesting thing about this, and I think this is the best public service that we can make here to people listening, is that by simply moving your money from cap weighted to equal weighted, you will be adding massive expected returns to your portfolio. You don't even have to go to some of the sectors that you and I discuss here. People don't have to go there. They don't have to take our word for that. But they simply can move their money to an equal weighted index, and by doing that, they are going to be protecting their nest egg from the next drawdown that inevitably is going to happen.
Yes, that's absolutely right.
So, moreover, what you see in the top left-hand side is that the valuations have now diverged from the earnings contribution of these concentrated companies in which the index has become. So information technology plus communication services, the blue line is the capitalization share, and the red line is the forward earnings. So how much they weight in the index and how much their earnings weight in the. What that's saying is that you're paying too much for these companies in relation to what these companies are contributing to the earnings of the overall basket. So it's another way of saying the same. Just by moving your money from a market weighted index to an equal weighted index, you are eliminating this distortion and you're protecting your assets.
Yes, that is probably the easiest investment advice our listeners can take. It's just one switch and the elimination of substantial risk.
That's right. And then at the bottom, something that we discussed, and I remember you raising this issue about how this excessive capex eventually is going to show up as these companies are spending as if there is no tomorrow in capex, and those are the dark blue lines. And the light blue lines is the corresponding AI derived revenue associated to that capex. So these companies are making a massive bet. They are all making the same bet, and they cannot all win together. Some companies that in the past were asset light, were money printing machines because they created one software product and then they could just replicate it at zero marginal cost and mint money with very light capex, are becoming now very capex intensive, and they're making the bet that the revenue is going to come. So they believe, Kevin Costner, right, and build it and they'll come. But the problem with that is right now they're all competing against each other for the same market.
Well, it's a very good example that you make, and it goes back to what Warren Buffett said about Google placing ads for Geico on Google, and he said their marginal cost for an ad is 0.
Mm-hmm.
We pay them X amount for clicks on these ads. So that model has now completely gone to the other side, where it's massive amounts of money and spending with a bet that many people can't see at the moment, and we don't know if this is a winner take all. Everybody's spending for sure, like this is a winner take all. That's the strategy they seem to be playing. So it's going to be interesting how it turns out. We certainly have not been playing AI. We're staying far away from it and choose other means to play the theme, like picks and shovels. And this is very impressive, and it is a huge contrast from the days of software and the days of the internet, which was a asset light, very high ROICs, to now what we're seeing.
Look at these charts. If you look at the little dots with the label oil majors,
Yep.
and you draw a vertical line, you get the capital intensity of oil companies such as ConocoPhillips, ExxonMobil, Chevron, right? Occidental Petroleum, whatever. Oil majors. And then if you project that line upwards, who do you find? You find Meta, Microsoft, and Google. So companies that in the past were asset light now have the same capex intensity as the oil majors. This is a fantastic chart, and I think it shows exactly the point you were making. It's telling that the dynamics of the competition has changed. And the other dimension is that in the past, Meta was in the business of connecting people through Facebook and Instagram, and Microsoft was in the business of providing utility software and cloud computing, and Google was in the business of providing search and ad search services and making money that way. And Amazon was in the business of e-commerce. Look at where Amazon is here. And Amazon was in the business of providing e-commerce and AWS cloud computing. And right now, they are all competing for the same thing. They are now all competing for ad dollars. And the ad dollars are not infinite. The ad dollar market is not going to grow to the sky.
Yeah.
So these people are going to be divvying up that business. And the business that remains to be competed against each other is the workloads associated with agentic AI. And that business is going to grow dramatically, but it's also a business in which these guys are going to be competing against each other to who attracts the most workloads for AI inference. So it's not a pretty picture for these guys. It can be a good picture, but it's not pretty compared to their history in the last 25 years.
Now, people will be shocked by the financial metrics going forward. I think there will have to be a readjustment in valuations because you're showing clearly here that the technology industry is a different industry. It's a different animal altogether. We have had a tectonic shift with respect to business models that need to be reflected in valuations going forward.
Each of them were in their own playpen before. And now the playpen became the same for all of them. So now they're fighting each other. In the past, each of them had a sort of a feud in which they could operate monopolistically. And right now, they're each against each other, right?
Yeah.
So it's going to be a completely different competitive dynamics and market structure. And as you said, a different business model as well.
Yeah, and here, even if it's sort of an oligopoly, you could still say, sort of a Nash equilibrium. Well, you're the economist, you know about Nash.
Well, in the Cournot equilibrium, no one makes any money.
Yeah, and
so if it's a quantity competition versus a price, what the Bertrand equilibrium, and if you remember from business school, IO class. If it's a quantity competition, which is I think what it's going to be because of all the massive builds and the need to increase capacity utilization, the margin converges to natural margins, which is essentially zero abnormal profits.
And here in Nash always used to talk about, okay, if we're a small amount of players, we have an incentive to cooperate, right? So you can still maintain some profit margin, but these guys here are not going to cooperate. They're all in the mentality that it's a winner take all. So they're going to...
Yeah, the reason they're doing this is not because of the e-commerce or the social media components or the ad search component. The reason they're doing that is because they think if they don't have the AI gods and someone else does before, that's the end for them. So each of them is trying to build AGI. So that's why they're building these massive clusters, because they're training these models, because they think if they lose that race, they're going to be toast. And one of the things we're seeing is that is a race that is more variable than an NFL game. Who is in the lead, right? Because if someone scores a touchdown and then the next one scores a conversion, and we've seen we thought that OpenAI had a massive lead, and then the Chinese came with DeepSeek, and they showed that with a fraction of the cost they could train a model that was pretty damn good, and now Baba has Qwen, and Qwen is having more adoption in many open source circles than any of the other models. And then you have Perplexity that is actually way more profitable than OpenAI, just focusing on enterprise and certain applications. And then you have Zuckerberg investing like a maniac in building his AI prowess, and then you have Google coming out with Gemini saying that they leapfrog OpenAI. The point is, these guys pretty quickly can move forward. And then at the same time, you have Microsoft, who has an entire lab dedicated to create an AGI. So handicapping who's going to win that race is impossible today. And in the meantime, they're building all this capacity right? Just to create something that they don't know who's going to win. So it's a totally, I mean, I love the framing that you gave, because this is a total case of a non-cooperative equilibrium in which they are overspending. So it's a typical coordination failure. If they could coordinate their efforts, they could create a consortium, make a club, but instead of doing that, they are duplicating efforts.
Which is why I brought up Nash, because Nash basically, prisoner's dilemma, it basically forces you to compete if you're a limited amount of players, and you take everyone's interest.
Everybody goes to jail with a fifth sentence.
Right. But here, it's not Nash, because they're not cooperating, and they will not cooperate. So, as you say, it's going to...
Well, the Nash equilibrium is non-coop. So the prisoner's dilemma equilibrium is a Nash equilibrium. But the fact that it's non-cooperative doesn't prevent it from being Nash. What a Nash equilibrium is an equilibrium from which no one has an incentive to deviate, even when it's a crappy equilibrium.
Right.
So that's what. So it's exactly what you said. These guys are trapped in a non-coop Nash equilibrium of very low quality.
Yes.
And shareholders are going to hell with this guy spending trillions of dollars in capex that is going to be very hard to monetize.
That's right.
Okay, so one of the things that's going on is I saw these charts from Fundstrat in which they're showing corrections above 3%. They're saying because we had 7 corrections, we shouldn't be worried about having more corrections in the short term because we are pulling forward corrections. And I say that's lunacy. I mean, it's as if I told you, Paul, here I have a box and it has 1,000 marbles, okay? And maybe 1 or 2 blue marbles mixed in the hundreds of red marbles. But trust me, these are all red marbles. And then you start taking red marbles from the box, and then you take 1 blue and another blue and 1 red and 3 more blues. You're going to say, oh, I took all the blue. No, you're going to say, Joaquin, what you told me is nonsense. There are many more blue marbles than you told me. So the conclusion that you need to draw from this instability is that we are in a way more fragile backdrop that is way more prone to accidents than the prior backdrop. So what we're seeing now is if you have 3 earthquakes in a week, you cannot assume that you are in an earthquake-safe area because we had 7 drawdowns in the last year. We're not going to have more. To the contrary, what you need to assume is that what changed is the frequency of accidents.
Right. I think this is an excellent time to plug the book we discussed a few weeks ago, Ubiquity by Mark Buchanan.
Mark Buchanan. Mm-hmm.
It discusses with many examples these type of events, and I remember the guy that gave it to us in our reading club was Todd Combs of now used to be Berkshire Hathaway, and now he's going to J.P. Morgan.
He jumped ship the moment Buffett did.
Yeah, but Todd gave us this book, I remember, and it's probably one of the best books that I've read in my life, and the lessons for finance are tremendous. And here, we can call the sand pile game, where we have an equilibrium, but it's a critically unstable equilibrium. And what I think, what this 7 corrections of X%, what that to me is mini avalanches that we're having in the sand pile, as to quote the book, and doesn't necessarily mean that you're another small avalanche away from a huge one.
Yeah.
But it does tell you that we are starting to see a window of instability that could lead to something.
Yeah, because remember that in the sand pile metaphor, small avalanche sort of relief pressure that prevent a big avalanche from happening. It's as if when the Swiss Rangers shoot at the snow at the top
Yes.
of the mountains to prevent the big avalanche from happening. So you could make that read and say, oh, because we're having mini avalanches, then it's less likely that we have a big one. There's another reading, which is a reading I am making. These mini avalanches are not release of pressure, are a symptom of a significant, more fragile underlying Markov process that is creating these outcomes.
And that's the point I was trying to make. You made it more erudite than me and captured it better, but that's the point I was trying to make. To me, these are signs of a sickness, if you will. And
Yes.
I'm taking them personally. I'm taking them very seriously. And
Yes.
when, as we are approaching the new year, um, this year I did a lot of things on some of our favorite ideas where I would do min maxes, sell puts and buy calls, and it worked very well. But now selling volatility might not be the right thing to do.
No.
So we might have to do change the playbook a little bit. Um,
Yes.
so I think that's what leaps out at me by looking at this chart and this slide. So
Yeah.
we're
So,
in
so
agreement.
I think, I mean, if you think in terms of Bayesian statistics, if you're really Bayesian and you really adjust your a prioris with new information, one of the things you need to be wary. I'm not saying that you need to agree with us or conclude the same things you are concluding, but you need to give readers to the case that we are not sampling from a weird tail, as this thing seems to imply.
Right.
But we're sampling from a different distribution that shifted altogether. And that the old low vol regime now may be transitioning into a way higher vol regime. And to your point, if you're going to be short volatility, do that at your own peril. Because if you're selling volatility and there is an accident, it's going to be very painful. To the contrary, I think this is a time to have convex volatility plays to the downside to protect the portfolio. And the reason you have this higher volatility ties back to what we just discussed, is the bets that the hyperscalers are making, the concentration of the market in a few names, the fact that doesn't matter how you measure your returns now are going to be significantly more impacted by what we call Jensen flips, when you have a big position that goes down, because essentially that's going to drag your returns down. It's not the same when Nvidia is 2% of your portfolio than when it's 15% of your portfolio. So there's no reason from a risk management perspective. I'm talking risk here, not in the sense that typically is discussed in the literature, in the financial literature. Risk for us is the discontinuation of compounding. Anything that prevents my returns to compound is a risk. And if you have a relatively oversized position on something that goes down because it's expensive or because it's exposing itself to a new market structure, then you are introducing risk in your portfolio that you don't have to.
That's I couldn't have put it better myself. We have to approach this new year that way. Make sure that you don't have big exposures. Rebalance your portfolio. Um, don't sell volatility, um, and buy some convexity. And this last week, I bought uh, 2-year leaps on Palantir puts.
Opinion and advice.
Opinion, not advice. But I, I I finally said I've got to get some downside
Yeah.
protection, and even though I love the company,
we love Alex Karp with all our heart.
He's awesome. But
Awesome.
just the valuation is
Yeah.
lends itself as a vehicle to protect downside and get
Yes.
good convexity on the downside.
Yes. Yes. So my prediction, I think we're going to see more gaps. I think we're going to see more whipsaws. I think we're going to see more people being forced out or margined out of. This is very, very bad for leverage, very bad for volatility selling, right? And any risk parity, any carry trade that assumes the old transition matrices, because we're going to have new parameters in the transition matrix that are not in anyone's models, right? And this is when the renaissance of the world mint money, because people start like moving like beheaded hens. So here, I think it's going to finally be the end of the by the dip, right? And I think people are going to start realizing that now we need to mind the regime, and people are going to start asking, in which regime are we on now? And when that happens, the equity risk premia needs to increase, because if you don't know in which regime you are, you need to be more cautious. And when the risk premia come up, you know what happens with prices. So in the old regime, a 3 to 5% flush was cheap optionality. In this regime, these frequent 3 to 6 drops are the normal symptom of a new microstructure, right? Of a new microstructure of a way more fragile market. And therefore, people are going to realize that those are not guaranteed reload points, as we put there in the page. And the buy the dip, I think, is finally going to die. Those are my predictions for 2026. I'm putting my neck out there. Let's see how I fare. So what's going to happen? The Fed will try to smooth things out. As you remember, people were saying, oh, the Fed is going to be hawkish and Powell is, I mean, the Fed is going to reduce the rates. Remember in episode 3, Paul, when we said QE is coming by another name? Okay, you had it last week. Yep. So they finally announced QE. So the Fed is going to play game with Treasury, and Treasury Fed are going to be one entity that are going to be trying to iron any of these wrinkles. The problem is what we said before. The problem is that when people are starting to doubt in which regime we are, just for the sake of portfolio management, they're going to become more cautious. The ERP is going to go up, and then people are going to demand more diversification in the portfolio, especially people know that PIX gets slaughtered. And after 3 years of outsized returns, people are going to say, why am I going to risk this? There's no need when there are easy ways to diversify out of this concentration. So we're not saying the market is going to crash. What we're saying here, the main implication, even without crashes, is that the sectors where the concentration is, those top 100 largest companies in the index, are going to dramatically underperform.
And if you've been paying attention, folks, you've already seen some of this rotation out of tech in these you see in the chart, and out of crypto. Crypto has gotten hammered, and I hear in the bubble vision that, oh yeah, it's the older wallets that have been cashing out. I'm like, well, maybe the older wallets are the smart wallets, because they've, I think Ethereum was down close to 50%. And people are doing exactly what you've just recommended they do. Is they've got their position has grown so large, they don't want to they don't want to fall prey to a Jensen Flip, so they're rotating out of some of those assets, and they're putting it into things like commodities, things like gold miners. So there's
what we're saying here is that there is no reason to remain in crazy town, as we labeled in episodes back. Look at the relative valuation in the top left-hand side of emerging markets versus U.S. equities. It's at like a generational lows.
Yeah.
Generational lows. We're saying that it hasn't been that low since the 1960s.
That's right, yeah.
Look at the middle chart up top. This is mid-cap. mid-cap is trading also at generational lows. Mid-cap value. You don't have to go elsewhere. You don't have to even leave the US. Just buy a mid-cap value index. Opinion, not advice. Consumer staples. The lowest expectations ever for consumer staples. And look at the bottom, right? The bottom right. The relative valuation of consumer staples versus the index. So you have the lowest expectations, the most attractive valuations, just buying like Procter and Gamble and no, and General Mills, Diageo. What was that? Clorox. I mean, just make a basket of 15 consumer staples, right? And you're going to dramatically outperform the index in the next 5 years, right? Opinion, not advice. So the same with international at the left. If you are a little bit more entrepreneurial, I think international, especially international small cap value, is a great intersection where to be. Emerging markets, you can easily move away from this microstructure that is posing significantly more acute risks.
Exactly.
Same with healthcare. Look at the top left-hand side. This is the weighting of the healthcare sector in the Standard & Poor's 500. You need to go back to 2000 to find a time when the weighting was as low as it is today. Look at the 1-year correlation at the right-hand side. This is rolling 1-year correlation between the healthcare over the Nasdaq excess return versus the equal weight. Not even the market. The equal weight is at the lowest level ever. So even from a diversification standpoint, right, as a diversifier, you are way better off buying these things. And look at the healthcare earnings beats at the bottom. They have the highest earning beats in many, many years. So it's cheap, it's underrepresented, it's uncorrelated, and it's beating earnings because they are so depressed, all the earnings analysts forecast on the profits of this company. So you have many fishing grounds where to go to diversify your assets without exposing your savings to unnecessary risk.
Yep. I'm so bullish healthcare and biotech, I can't pee straight.
Exactly. So I want you and I to go back to this notion of cash flow of the Magnificent Seven, including maybe Oracle. And we know this is not new, right? We know, and I remember you discussing this in episode 2, that these companies were going to have deterioration in cash flow, and we're seeing this already. The chart on the right says big tech has a cash flow problem. This was so obvious to us that this was going to happen because it's definitional. What is free cash flow? I see many people who talk about free cash flow and capex, and they don't even know what they're talking about. So let's get the semantics right. Free cash flow is operating cash flow minus capex. Okay? It's not I take my free cash flow and then I can decide to spend it in capex. No, free cash flow already has capex subtracted from it. So this is like a tautological conclusion. If you increase capex dramatically, right, and OCF is not increasing that dramatically, free cash flow by definition is going to come down. So now it seems that Michael Burry discovered that if you increase capex, free cash flow is going to go down. No. I mean, I don't know if Michael Burry ever read or understood the definition of free cash flow. But free cash flow, again, is OCF minus capex. So if capex goes up, free cash flow goes down. There's nothing you can do about it, right? And now he's going and making the rounds as if he discovered, gold under his bed, saying, oh, but in reality, the issue with it is that they're assuming the depreciation life of their assets to be 7 years, when in reality, these things become obsolete in 3. Who cares? We can read a cash flow statement, and we know that if these guys spend more money in capex, the cash flow goes down. And investors are not stupid. Investors are not waiting to see what happens to depreciation to value a company. They look at the cash flow statement, and they can see today, as we're seeing in these 2 charts.
Yeah, I think you're right. I must admit I fell prey to the narrative that Michael Burry was touting. but thinking through it a little bit more and talking to you about it, I came to my senses. I regained my sanity, if you will, and it is true. Both of us, having been CFOs, we know exactly what a statement of cash flows is, and the early warning is the expenditure. Forget the depreciation. You can
Yeah, who
depreciate
cares?
the assets over whatever time frame you want. It's going to be
Yeah, and Michael Berry, I can imagine his retort. I mean, after he understood the definition, which I think he didn't before, and he looked it up in a corporate finance book, he's going to come back and say, "Well, yes, but if they're right and their assets last 8 years, then the frequency of this capex is going to be less than if these chips only last 3 years." But the reality is that to answer whether that's relevant, you need to know what demand is going to be,
that's
and
what
we don't know
I'm
what
saying.
demand is going to be.
We don't
Because
know.
if demand crashes, who cares what the depreciation or the free cash flows are? Is as we saw here, right, in the page in which we're showing the relationship between capex and AI products. If the light blue doesn't go up, they're screwed. Doesn't matter what assumptions you're making.
It comes down what you're saying. In other words, is nobody knows what the TAM is, the tangible addressable market. So
No,
if nobody knows, then
not even Michael Berry.
yeah, it, and none of these guys in any of the hyperscalers know, which is why they're spending so much money, because they only see that it's growing. The
Yeah.
the and we do know, you and I posit that we are in a world headed towards infinite compute. So
Yes.
um, I think you and I would probably be more in line with an argument that says, yeah, the TAM, tangible addressable market, is bigger than people think. The question, when does that develop over time before you get some hiccups in revenue generation, with
Yes.
operating cash flow
That's
and
that's
capex?
that's that's the key. The key
That's the
is whether there's going to be a gap between when demand comes up and these guys need to respond for their capex.
exactly.
Exactly right.
So it,
We made that case in the last episode. We say there is a lot of headroom in training, in data, in data usage to improve models dramatically. We discussed all the tricks that they're using to improve outcomes in training, to make the models more parsimonious, to make them more energy efficient. The use of agents, MOE, mix of experts, thinking. These guys have many tricks left and many more than are yet to be invented. So my take, simply by using AI every single day, is that the utility they provide today is insane, and the utility that these guys are going to provide in the future is going to be gargantuan. I need one of those Jensen Juan adjectives, right? I mean, it's going to be like bad shit fantastic, but the use is going to go up and demand is going to be stratospheric. The question is whether that adoption, because of the model improvement, is going to come sooner or later.
yeah.
Because when that demand comes, inference is going to be stratospheric as well, and therefore doesn't matter how many chips you have, you're still going to be using all those chips to perform infinite demand of compute.
Yeah. And God bless them, these hyperscalers do have profitable business models that generate good operating cash flows.
Yes.
And that's what they're using, and they're starting to use, uh, too much of the operating cash flow they're making, which is what's making us a little bit nervous about this timing. But
That's exactly right. What you're seeing here,
yeah,
that's the breach of OpenAI estimated P&L. So this is a money pit.
yes, yeah,
So they are burning cash, they're burning everything, and they are doing all these circular deals because they cannot keep up with cost. side of their P&L, and they need to get cash in, otherwise they need to shut down. And the approach they're taking is to offer almost free compute to train people to use them and to develop a relationship with people that they hope is going to translate into competitive advantage. But that's the reason they're doing what they're doing. That's the reason why they're going another funding round. That's the reason they're saying that the company is going to come out at $1 trillion. I mean, $1 trillion. Imagine that.
Yeah.
I mean, $1 trillion in market cap. How much? What earnings do you need to have to justify $1 trillion in market cap?
Yeah. And these models, the better they get, the more of them that pop up. I wonder about the elasticity of demand with any of these particular models. It may become inelastic and these infinitely elastic. Sorry about
Elastic,
that.
Yeah.
And you might have.
So you're describing the demand elasticity of utility of the models, right?
That's right.
Yeah.
And we might start seeing people jump from one model to the other and pay this month for ChatGPT, pay for Perplexity the next month, and just switch. And it's going to be hard to get pricing power.
I think that's one scenario in the transition. I think at least there's going to be another transition in which models are going to become personalized because they know all your history and they know all the things you discuss with them, and they have your schedule and your pictures and your bank accounts and your travel itineraries, and they know your preferences. And and then if that happens, then those things are going to become sticky, and that's exactly what OpenAI is betting on. OpenAI is betting that they're going to build memory, and these things are going to be like your personal agents, and you don't fire your secretary because there is a cheaper secretary in the next building, because you have a relationship with your secretary, and he or she does exactly and knows you and knows your preferences and your quirks, and therefore you value the loyalty and you have a personal relationship. And I think that's what they're betting on. At the same time, I think that there might be a regulatory intervention that appends the whole thing. It may be the case that the regulator says all that memory needs to be portable the same way your mobile phone number is portable, right? And they say, because you cannot trap a consumer into this thing. If that happens, then you're right. It's going to be a race to the bottom. Profits of the models are going to be zero. And then the question is, who's going to be making money?
But you do have a good point, and it's right in line with the competitive strategy definition of switching costs.
Yeah.
That is the big aim has got to be to raise switching costs.
Yes.
In order to
no question about
the ecosystem.
There's no question about it. I think long term, I think you're right. I think long term, you're right. Just a wild guess. I mean, who knows? But if I had to project based on prior market structures that share some of these features, I think there's going to be a period in which they compete as commodities. Then they're going to become personalized and they're going to have some market power. And then there's going to come the regulator and going to say, no. You cannot just monopolize your relationship with a consumer. If the consumer finds another model that provides, better service at a better price, you need to give them the parameters of the memory, and they need to be able to port that to wherever they want to go.
Right.
That's what I think should happen. Yeah. But this is not what these guys are planning for.
No, not at all. But
there is Michael Burry, talking about all this nonsense. And look at the things they claim, right? What do they claim? They claim that there is specifically talking about NVIDIA 10Q filing. They say their receivables look very strange because their DSOs are expanding, and they have a 16% degradation in collection efficiency. So essentially the claim is that the ARs are turning into doubtful accounts, and eventually they're going to turn into bad debts. And then I say, who's the moron who pays any credence to this nonsense? Let's think together. Let's think together.
Seen in the expenses a provision for doubtful accounts increase?
No, they're just not even that. Not even that. There's not yet. What they're saying is that their DSOs are going up. Essentially, just for the layman, is essentially that they are collecting their sales more slowly, right? Sales outstanding essentially going up. They're not even claiming that these things are creating already, provisions on these potential bad debts. What they're saying is that this is suspicious. They call it the receivables anomaly. And then I think to myself, who was selling NVIDIA before the GPUs became the GPUs that are today? They were selling to a multitude of small companies that they were buying their GPUs. Today, who do they sell to? They sell to Amazon. They sell to Microsoft. They sell to Oracle.
Do you
They
think they're
sell.
not
They
worthy of
sell.
extending more days payable?
Yeah, but think about it. They sell to the bluest of the blue chips,
Exactly.
right? So what risk do you think those ARs have? This is just a short seller trying to create buying back opportunity for herself or himself. This is just utter nonsense, right?
This
Then say that again.
as as a CFO, I can tell you it's utter nonsense because I could see my receivables jump up in days outstanding because let's say I'm selling to a larger customer, more creditworthy customer.
Exactly. That have their own terms and they say these are our terms
Yeah,
and we pay you 30 days and you could impose 15 days to your payroll customers but not to me.
exactly. And
Exactly
you
right.
know, if I've got a you know 5-star client, he can dictate his terms, and frankly, I'm not going to argue with him. Not when I'm
You're
hard.
getting 80% gross margin on these things.
Yeah, it's ridiculous.
So then the next they call it the these are excerpts from a moron who wrote all this stuff in the internet, okay?
Right.
So he calls this the inventory paradox, right? So what they're saying, essentially they're suggesting that Nvidia is stuffing the channel and they have bloated inventories as a proxy for clogged channels and weak demand. So I mean, and then, and then you think, wait a minute, what are you saying? Are you saying that Jensen Huang? Do you think in Jensen Huang's brain there is room for channel stuffing? Who can believe this nonsense? But these things are making the rounds, Paul, right?
No,
These are the short sellers like Mike Burry are making all these. I don't have a horse in this race.
no,
I'm not long Nvidia, right? I'm just saying this is just defamatory for the sake of being defamatory.
yeah. It's they're obviously short, and they're trying to grasp at straws. But from an accounting standpoint, this to me certainly doesn't look like channel stuffing, and the inventory increase to me doesn't is probably well explained by having better customers, smaller amount of customers, but bigger customers because you go direct.
That explains the DSOs going up. But this inventory thing is also very natural to explain. What's going on is that the chips, as they move from the Hopper to the Blackwell to the Super Blackwell, those chips are significantly more expensive. Those chips, even when they are coming from TSMC, are significantly more sophisticated chips. But not only they are more sophisticated chips, when they arrive at NVIDIA's warehouse, they need to add the high bandwidth memory chips. And the only way you can secure HBM is to buy from Micron and SK Hynix and all those guys like 1 year in advance. And these guys are going to deliver the memory chips whenever they ship them. And you're going to store those memory chips in your warehouse. And therefore, in your balance sheet, they're going to show up as increased inventory simply because you cannot sell GPUs and ship them without the memory chips. So it's totally explainable. It's totally natural. These guys are making a tempest in a
Right.
teapot on things that are completely natural to happen.
And from an accounting basis, that inventory is probably part of construction and process.
Exactly.
So
Yeah.
if you looked into the notes of the financial statements, you should see an inventory breakdown and you should see construction and process. And that's probably going
Uh,
sky high
I'm good. I went back and did the math. I'm going to show you.
Okay.
But the reality is that all these guys are making the rounds. You don't have to believe any of this nonsense not to be in Nvidia. The reason not to be in Nvidia right now is because there are cheaper, better ways to put your money where you're not exposed to a Jensen Flip. It's as
Yeah.
simple as that. But because these guys want to provoke a quick market reaction, they are spreading all this
Yeah.
nonsense, right? Which is pseudo-scientific, and I mean, it shows how ill-intentioned they are, right?
It's very first level thinking. It's what I call
Yeah.
first level thinking. They haven't gotten to second or third level analysis. It's very
Yes.
poorly done.
Yes, and this is the last one. The last one is Mike Burris, our famous Mike Burris, doctor in medicine. He's trying now to make a little bit of money selling subscriptions in Substack, and that's why he's spraying all this nonsense. He's saying that the allegation of useful life overestimation, right? So essentially saying these chips don't last more than 3 years in a straight line accounting depreciation. These guys are assuming 7, 8 years, and that's nonsense because by the time you reach the 5 year, those chips are decommissioned, are worthless, and you need to spend again. The point is mute because we know how to read a cash flow statement. We don't need to make any assumptions about depreciation to realize that these companies are becoming cash flow negative, right? So that's nonsense. But anyhow, this is the point he's making. What's the definition of depreciation? You have the formal depreciation definition from the regulators, right? And then you have what I like to call depreciation, which is the portion of a long-lived asset's cost that is assigned to and reported as expense for the current accounting period under a chosen allocation method. As you and I know, there are many allocations methods, so on and so forth. Now, if you're going to change, and you are a CFO, if you're going to change the time lapse until which you expect a GPU to last, if you're going to reduce that, clearly that's going to increase your depreciation. So you need to have some semblance with the real economic life of the assets, right?
That's right. And
so the point I'm going to make with this table is, if you look at the chips that are in the market from Nvidia, you have the GB200, which is what they call the highest Blackwell. Those were launched in March 18, 2024, and are shipped as we speak, right? Those are the GPUs that Jensen is selling now, together with the B200, which is also the Blackwell. Those are being rented at almost $9, and the B200 at $5. Okay, those are the latest generation chips. They are used for training and high workloads in inference. And then you have the H100s. Those were launched in 2023. They're very healthy rental rates. Then you have the A100s, were launched in May 14, 2020. Again, very healthy, very profitable, still working and humming, right? And then you have the B100s, the Volta chip. This chip was launched 8 years ago and is working, is profitable, and is being rent non-stop. So there's no reason whatsoever to assume that if you have all Volta chips who are still running workloads and being profitably rented at almost 60 cents an hour, and they were launched 8.5 years ago, there's no reason whatsoever to assume that the latest generations of chips, which are way better, are going to have a shorter lifetime.
And what he's suggesting is that you take an impairment charge almost of those chips because they're past 3 years old.
Yeah.
So it makes no sense. If they are generating economic profit.
All a bunch of BS, and they're just trying to make a quick buck on, essentially on scratching Nvidia.
Yeah, that's right.
So it is what it is. Okay, so here are the promised numbers, right? ARs. There are not too different from what they were back in 07. So yes, they came up. Why they came up? Because now they're dealing with Microsoft, Amazon, Google, Meta, and Oracle, right? In the past, they were dealing with many smaller OEMs. Now they are dealing with a handful of pristine AAA grade hyperscalers with whom they have zero impairment risk for their receivables.
Right.
So what do these guys demand longer terms, as you said, right? That's the answer. And number two, they have quarterly volume-based shipment windows. They don't accept the chips whenever you want to ship them. They say you're going to send them at a certain time. That clearly, has consequences on your revenue, cadence, and the receivables, right? And these firms, they do not default. I mean, these are like cash gushing machines. They're not going to default. And if Microsoft defaults, that's the least of your problems, right? Yeah. Because it means that there's something else going on in the world. So the only thing that's going on with the ARs is shifting the clientele that they have, and all the other companies that have the same trajectory, such as AMD, Broadcom, Marvell, Arista, have seen when they start selling to this type of clients higher AR terms and more milestone-based revenue recognition. So this is nothing different from what everybody had. The inventories, there is not even a blip there. Inventories have been pretty flat. There's been a small uptick in the last quarter, right? Yeah. But compared to other periods, it's nothing to be talking about. It's like zero, just looking at the data. And then the final point I would make here is we don't need Mike Berry to tell us how to read cash flow statement. If you look at Oracle in the last 12 months has minus 27.4 billion in free cash flow. And in the last quarter alone, they had 8.5 billion cash flow. Okay. Right. And if you look at what's going on with their capital efficiency, clearly it has suffered. So now the question is, if you look at return on ROIC or ROA or ROE, I mean, all those things are suffering clearly because they are taking the depreciation and the revenues associated with their capex have not yet fully matured. So it's a question of the key question is a question that you raised a few minutes ago, which is there going to be a gap between the uptick in demand and when these guys need to report earnings associated with these investments?
That's right. Yep.
So again, another look at their negative cash flows. This is a very good report from Carlyle. These are excerpts from their report. They're showing the massive growth in capex and how this is reducing the cash return these guys are having today versus when they were asset light. As you can see, Amazon is 1,300 bips worse. Microsoft is 680 bips worse. Meta is almost 600 bips worse off, and Google is 550 bips worth in terms of cash return on equity than when they were before December 22.
Right.
And then they did this valuation exercise. They essentially say we're going to value the most recent capex at market value, and we're going to value the rest of the book at 10 times. When they do that, it's just directionally correct. Of course, there's no precision. They conclude that these guys are overvalued. And then what happens when you are overvalued? What you have in this page, what's the trajectory of EPS and the Magnificent Seven stock prices. We put bubbles around the same period before and today, and what's likely to happen. Again, opinion and advice. When you're spending all this capex, and your earnings are going to suffer, and your valuation detached from that earnings trajectory, the most likely path for these prices is where the red line is.
I think people need to use the Charlie Munger's line of thinking, which is, not look at what can go right. Let's first look at how can we screw something up?
That's brilliant. I love it.
And here we have a perfect example of, where's a place you really don't want to be?
Exactly.
So let's focus on where we don't want to be, and then we can focus on where we want to be. Because these are...
Yeah, so I think Michael Burry is going to be right for the wrong reasons.
Yeah. Yeah, that's probably true.
So my take is that all of that is quite irrelevant, except for driving the conclusion that you just drove, which is always invert, and think what can go wrong, and why you don't want to be in a place where there are so many reasons for things to go wrong. particularly when you don't have to, because you can be in places where are so derided, so ignored, so forgotten that things are much more likely to go right, are cheap, are abandoned, are despised. So all the sectors that we just discussed. So that's the main takeaway here, and I think it's a public service to people who have saved for many decades. This is a before midnight, in Cinderella, when everything turns into pumpkins. You need to escape before midnight, because when everybody wants to get out, there's no enough room through the same door, right?
Right.
And the next takeaway is that for all these reasons, all that capex is going to be on the ground. All those models are going to continue being trained and adding utility and value. I 100% agree with you that elasticity, demand of utility of these models is vertical, right? I don't know how high it is. And we also know that everybody and their mothers are trying to produce accelerators. Google has the TPUs, Microsoft has Maya, Amazon has the Trainium and the inference. Everybody, Broadcom, Marvel, Allchip, everybody's doing ASICs for specific workloads. There's not going to be a dearth of chips. People are building new capacity to manufacture more chips. And we heard people such as no other than Satya Nadella saying, I have the chips. What I don't have is the warm shells where to plug them, right?
Right.
So the real operating constraint is energy. It's not about the chips or the models. There are many people, many labs, running models. There are many Chinese spies in those labs leaking to the CCP the latest advancements. So those guys are not far behind. There's going to be an arms race in terms of improving these models, which is probably good for humanity in the sense that that's going to advance faster. And what really is going to become the bottleneck is energy and maybe memory, as we say there. But compute, contrary to what Mike Burry is saying, doesn't go stale, because as we saw before, while the workloads scale to the top of the available computer frontier, even the older Jurassic chips are still being used for other workloads, exactly. Right? And when you're going to have all these demands, so what's going to be interesting is that there's going to be a huge demand for making these chips usable. And one of the things that we're seeing is that they're taking these old clusters of chips and they're retrofitting them with memory and CPUs to orchestrate new workloads, such as agentic AI. So my take is, in the short term, we're going to have all the chips that we need and all we want. We're going to have models that continue improving. Based on your elasticity, we're going to have crazy demands. And what's going to stop the advancement is whether we have the energy or not to put those chips to work.
That's right.
As this tech diffusion paper stresses, memory may be one of the big constraints. Micron has been one of our favorites in the Technium space, together with the picks and shovels, almost because we see memory as a pick and shovel, right? Or pick or shovel. And that's been very good. Say it again.
It is, and there's a limited amount of guys that can produce that high bandwidth memory and the one that is needed most.
Yes. And we have news such as this Aeon model by Alibaba, by which the Chinese managed to improve via virtualization the efficacy and effectiveness of the same cluster of chips. They make the chips more productive, which again goes back to the criticism to the Burry thesis, which is there are new ways to extend the useful life of old chips.
Right.
So this is going to continue happening. And again, this chart is staggering, because you look at annual electricity generation from China and from the US, and you can already see how Chinese energy generation, dwarfed US generation, but you also see how stagnant is the forecast for US generation. And at the bottom, that orange is only the electricity that AI is going to demand. So how are you going to put more clusters in the US if the US cannot step up its energy generation? So this is something, this is an accident waiting to happen. And if you cannot conceive how the US is going to alter this trajectory, you can already conclude that we lost the race against China.
Well, and what this is screaming at you is that nat gas production and prices, because price begets production increases. So
Yep.
we need to see price appreciation in natural gas, and we also need to see the construction en masse of, let's say, behind the meter
Mm-hmm.
natural gas turbines, or some other some other type of energy. I can't see renewables because the intermittency and things like that becoming an issue. But I think energy and energy infrastructure scream out at me as
Yep.
investment thesis right now.
Yep.
From this,
Sooner or later, because if you listen to G. Vernova, for instance, which is the producer of the gas turbines, they are sold out for the next X years, like 3, 4, 5 years. The production ramp up is very tough. It's a very specialized type of manufacture that you just is not flip a switch and then all of a sudden you have more gas turbines. I think the only way to solve this conundrum sooner people will realize is the mini grids, where you can supply the residential consumption via less demanding grid and then reserve the high voltages and the reliable supply that we have today for this. We know the SMRs are going to start being, maybe commissioned at the beginning of the next decade, right? So we're talking about 2032, 2033. We are not going to find new rivers where to put hydro. Coal, it's clearly the best we can do with coal is stop decommissioning and maybe commission a couple of the old coal-based electricity generation plants. But other than that, it's very hard. And the sun is, coming out every day. And if we have mini grids, as many as we can, and we have solar and batteries, we can take all that consumption out of the grid and preserve the baseload capacity that the data center needs for the data centers. Maybe,
that's right.
I think regardless of where that happens at scale, the market is moving in our direction. We showed the numbers for lithium. Natural gas is the head scratcher, as you said.
Yeah.
So there is an impending power crisis. That's where demand peak supply needed in yellow and peak supply anticipated. In fact, there is a decline because of all the potential decommissionings of existing generation, which hopefully we're going to stop. Energy storage is going to account for 44% of global lithium, which goes back to this thesis that we're going to need a lot of storage to supply the non-data center uses of energy. Again, here is the quote from Satya in the BG Squared interview. He's saying, I don't have warm shells to plug the chips. So I have the chips. I put at the bottom left the marginal return on capital for Microsoft for different time periods. I think Microsoft is going to be one of the winners, despite the fact that they're investing in CapEx similarly to other hyperscalers. They still managed to maintain 22.2 marginal return on capital, which is incredible.
Impressive.
Is impressive, right? So, and then you're seeing all these former crypto miners that are now becoming data centers energy suppliers because they have the energy rights, and therefore they're saying there is a way higher and better use, and they are essentially reconverting to become from Bitcoin mining companies pivoting into suppliers of energy, reliable energy for data centers. I think we're going to be seeing a lot of that. The other thing that this shows, I think, is the infinite willingness to pay for energy after these data centers are in place. So if these guys need to bribe communities, they're going to do that, because after you have, $14 billion in a data center, you cannot not turn it on because you don't have enough electricity.
Let's respond very clearly. The question is a megawatt of power best used in the data center or in mining Bitcoin?
Yeah.
I think people get the answer is obvious.
Yeah.
What one produces extremely more utility than the other. It's for me, cryptocurrencies were a solution for stranded sources of power, like aluminum smelters were a solution in the 70s for the Saudis, who were basically flaring natural gas. They bought turbines and they started making aluminum, which is basically mostly energy. So you turn energy into metal. So crypto became a new iteration of that. And now I think crypto is going to get left behind because the need and the utility or the return accrued to a megawatt of power through a data center is infinitely greater.
Yeah. So the point we're making here is exactly that. The hyperscalers have demand elasticity near zero for electricity, right? So it doesn't matter the price, you're going to buy the same amount. So if 1 megawatt produces, $300-400 million in NPV, right? They're willing to pay 50x the wholesale rate, and that's totally rational. And here at the middle of the page, we're making the same point you made earlier. There are going to be a lot of BTM deals done, and hyperscalers will do everything. They're going to buy power plants. They're going to buy stakes in utilities if they're allowed to. They're going to buy land adjacent to transmission nodes. They're going to co-locate their data centers by gas fields where they can quickly plug a turbine. I think there's going to be innovation in the space, and someone is going to come with a better turbine that is faster to commission. They're going to be making 20, 30-year tolling agreements. They're going to restart retired gas plants. I think anything is going to happen, because the only thing that cannot happen after they spent all this money is not being able to turn them on. Some of the quotes, Andy Jassy saying, we expect to double our overall capacity by the end of 27. Double. I mean, AWS is saying they're going to double. Satya Nadella, today overall in the industry, maybe the bottleneck is power. Maybe. We have the most expansive data center fleet for the AI era, and we are adding capacity at an unprecedented scale. Energy wasn't even discussed before in earnings call, and now look at mentions of power in this last earnings season, right?
That's right.
So in the past, they only talked when they were complaining about the high prices of oil. Now they're talking about, because they're saying we don't know where we're going to get the electricity that we need to power AI. There are more than 35 behind the meter natural gas AI projects announced this year. That's a report from Wells Fargo. That number was less than 5 in 2024 and 0 in 2023.
Yeah.
So at the same time, energy has the lowest share in the Standard & Poor's 500 since for a century.
Yeah.
In a century. So talk about a generational opportunity.
My great grandfather was drilling oil in Pittsburgh.
Exactly. So this is oil prices. We're not even talking about natural gas. We're talking about oil prices, right? Earnings expected to improve. Oil prices adjusted for money supply at record lows, with the exception of the 2000 crash and the mini debacle during COVID. It's impossible to, in my head, create a scenario in which this is not the binding constraint.
I agree.
The second order is that the value shifts as compute becomes abundant, which is our base case.
Right.
So once chip supply catches up, the power constraint stays tight. And the differentiation moves from hardware to orchestration. So all those chips that were doing like one-off data center workloads, now you want to use them together for agentic AI. That's what drives what is called this trend in orchestration. And guess what this trend in orchestration is very intensive on?
Energy.
Energy, but also is very, very intensive in memory because you need to keep all that information together in a data center to process it.
It's sort of
so you need
for longer.
There you go. So you need HBM aware batching. You need multi-GPU virtualized clusters. You need cross data center model splitting. You need parallel speculative processing. All these things, the only thing that they need more, even with the same old chips, the Voltas of 8 years ago, if you add memory and you add orchestration and you add virtualization, you can make those chips ham. Now, to your point, when I said what was the next driver of demand, these memory chips are incredibly energy hungry. So this is all converging into energy being a massive tsunami of scarcity.
Right.
Okay? So this is already what we discussed before. The hyperscalers, if they have to, they're going to subsidize consumer bills. There's going to be probably what we said is a bifurcated grid. It's going to be an A grade power, right, which is what we need for data centers because you cannot fuel a data center with solar and batteries.
That's right.
And then you're going to have consumer power, which is going to be falling after hyperscaler subsidies. Right, so utilities with large rate-based proof for expansion, Duke, AP, Nextera, XCL, those guys are sitting on a gold mine because hyperscalers, when the regulators see that there is enough alternative power for consumer power, they're going to free up the utilities to sell to the hyperscalers, but there's still going to be scarcity. So these guys are going to be able to check up rates 10 to 50 times. It's something that it only dawned on me in the last few weeks. Why the utilities continue going up? Because the price of the base load power is going to be infinite potential.
Yeah.
So infinite, quote unquote. In summary, we believe that energy is the binding constraint. We believe that compute will not go obsolete as long as orchestration and virtualization come to save the old chips. We also believe that memory, HBM, is a scarce input because you need HBM for the new workloads and you need HBM to retrofit the old clusters.
Right.
Chip will eventually see supply catch up, but power not. So AI grade power will be priced like rare earth metals, right? It's going to be gold. Hyperscalers will subsidize the grid and become quasi-utilities. And then there's going to be multi-agent computation increasing almost without bound because of the utility and your infinite elasticity. And the orchestration layer is where the new battleground of competition is going to happen. It's going to be whoever can provide a holistic solution and make you sticky in that relationship. Those are the ones who are going to be winning the.
Who's your best guess of the winner in the orchestration layer?
I think it's very hard to tell right now. If I had to bet on a horse, opinion and advice, I would bet on an onsemi.
Onsemi.
I think onsemi. Yeah, I think onsemi. Maybe STM, although STM is still too dependent on the auto industry, because the orchestration layer is very intensive on managing power within the data center.
Right.
and just to keep the right amount. Remember, this every microwatt is going to be like a drop of gold.
Yeah.
So you will have to orchestrate, and orchestrate requires harmonizing all these voltages and all these switches and all these changes. You can do optical networking, but you cannot do optical thinking because the chips are still based on electrons moving. So every time you get to a CPU or a TPU or a DPU or a GPU, you need electricity consumption.
Right.
And therefore, doesn't matter how much optical networking you build, you will still be increasing the demand of power that is going to remain scarce. So whoever provides you as a data center. So remember, we said these guys were asset light, and now they're asset intensive. They're asset heavy. So these guys in the past had to think about how many licenses we sell.
Right.
Now they'll have to think, what is our capacity utilization in the data center? How well are we using the little energy that we have? So they're going to become operationally savvy. That's where the next driver of profitability management is going to come. So they're going to say, whoever gives me the best optimized data center, that's with whom I'm going to go with. And onsemi has like the patents and the positioning to provide the stack of microcontrollers, switches, harmonization drivers that these guys are going to need to be effective and efficient in this new age. So I think onsemi doesn't seem cheap, but I think those guys are being very strategic and very, very deliberate in going after it. And of course, it's going to be your copper, because all these things require copper wiring. And we're not even talking about physical AI. We're not even talking about autonomous robots that are going to also consume copper. We're talking about just retrofitting the grid and laying copper cable within the data centers, and taking into account the fact that electric vehicles are going to be very copper intensive, and that's also going to continue growing. So even before talking about physical AI, copper is going to be another winner in this orchestration age. So I think if I had to pick two, I would say onsemi and Freeport.
Freeport. Well, those are both in our portfolio, so.
Yes.
So.
I'm going to go quickly here, but I think the model that you have here at the bottom, I think it's important for people to make sense of what's going on. Is the cobweb, and what describes is a situation in which, let's say that you start in B, right at the bottom left, with price P3. At those prices, you have excess demand, which is what we're seeing right now.
That's
right. Let's say GPUs, and then the price jumps to P2. And when the price goes to P2, much higher, everybody wants to make chips, right?
That's right.
So while this is happening, companies that realize 80% profits have booming stock prices because the price is up there. So supply lacks demand, but then people start setting up their fabs and setting up their designs. So what happens next? Even companies with names that start with Qual, like Qualcomm, announce their entrance to the accelerator market, as we saw Qualcomm do. Of course, we discussed Amazon, Microsoft, Google, all of them producing. You have everybody producing accelerators. Even Microsoft announced that they're going to be powering Azure with a Maya AI accelerator. And then when this happens is the supply moves to point B, right? Mm-hmm. And when supply moves to point B, you have excess supply, and that's the period in which we're going to have the bust. Whenever that's coming, I don't know. But this is a cobweb that is actually being drawn in our market structure for eventually everybody produce chips, which means prices collapse. And then by this time, the entire supply curve shifted because everybody is going to be producing chips, and TSMC created more capacity, Intel created more capacity, everybody created more capacity. And this is another layer as to why this is a very fragile state in which
we move to point C.
Exactly right. Then you move to point C. Exactly. And now you move to point C because the supply curve moved altogether, right?
Yeah, that's right.
Exactly right. So this is a summary. I'm going to let people read them at their own leisure. The rise of multi-query, which is multi-agent orchestration, transforms data centers from throughput optimized to state and memory management systems. And that's why we're so bullish on memory. And that's why we're also so bullish on energy. This architecture is also CPU intensive. So that's why Intel is going to catch up and not win, because you need to put more CPU for orchestration. Before you send the data batch to be processed, you need a CPU to organize at what time and in what sequence that data batch is going to be. And when you asked who's going to win in this orchestration race, I would put Intel there as well. But not because of memory and not because of GPUs, but because of CPUs.
Another one in the portfolio we have.
Very important point to understand here is that in the past, data centers were like request response, one user, one service, one result. AI native centers are multi-agent graphs. So it's one query, like you said with your legal documents. You say, give me a summary and pinpoint potential risks associated with this contract. That fans out dozens of queries, embedding search, retrieval, reasoning, planning. So that becomes orchestration necessary. And that's why you need so much memory and so much more energy. And that's only going to increase when agents are actually doing work for us. So it's just a summary of what we think is going to happen. This is just a victory lap. Because
RGM, our
RGM, right? That was what I remember if it was episode 2 or episode 3 when we discussed tariffs. We were pounding the table saying there's not going to be inflation associated with tariffs, and you can see there inflation came out last week and it was significantly lower than people expected. I think that's going to continue. Eventually, you and I think inflation is going to go up, but not because of tariffs, but because we are in fiscal dominance. Exactly. And eventually the Fed will have to monetize the deficits and will have to create yield curve control and will have to create financial repression just to make the government viable. That's going to drive inflation. But right now we're seeing the 1 year and 2 year inflation swaps collapsing. At the same time, we have all the tariff that Trump wanted and maybe some more. And then we also nailed our forecast of what was going to happen with GM, because you need to understand, in one case, we're talking about economy-wide, a large economy that is not a price taker, versus a market that is highly competitive and where margins are very thin, where we knew prices were going to provide a dramatic increase in profitability for GM. Even though 10% tariff only drives 5% price increases, remember that profit margins in the auto industry are under 5%. That's right. So a 5% price increase may represent 100% increase in profitability for the automakers before taking into account the fact they're going to be producing more cars, not less. Right. So that was another one we nailed. We were laughing when we read this headline that markets no longer view December rate as a sure bet. I think they're going to continue easing. They don't have an option. And the fact that now they committed to buy treasuries makes the rate decision even irrelevant, because Besant can do the other thing we predicted, which is Operation Twist. He can even start buying 10-year bonds and funded with treasuries, and the Fed, just to keep the rates at the policy level, they have to come out and buy more. So right now we create a situation in which we have QE by another name, as we predicted. This is going to continue happening as far as I can see. The only thing we think is very dangerous is that someone like Trump falls for the Kevin Warsh trap. I think Kevin Warsh is a dangerous guy. I think it would be the worst possible pick he could make. I think Kevin Warsh could be it would be a disaster. I hope his instincts are the right ones and he picks Kevin Hassett. Not because I think Kevin Warsh is unqualified or he wouldn't be in a normal scenario out of fiscal dominance a good Fed chairman. It's because we need someone who understands that the only way to get out of this conundrum and to win the race against China, which is a geopolitical foe of incredible force, is to let inflation run hotter for a few years. That's right. We need to let inflation go for 5, 6, 7, 7% for a few years, the same way we did after the Second World War, the same thing we did in the 70s. No one is talking about Argentina or Mexico or Peruvian or any of those African countries hyperinflations of like 10,000% per year. We're talking about single digit inflation. The notion that we can survive fiscal dominance with 2 or 3% inflation is just delusional and deranged. We need a Fed chairman that is going to be accommodating, is going to enable the inflation to run a little bit hotter.
And right? And we're going to need it too, because there are liquidity needs that are coming due. Howard Marks in his latest memo was talking about $1 trillion in real estate debt, commercial real estate debt that was coming due in this year. And as you know, there is this maturity wall, and I think we both have looked at Michael Howell's work on liquidity needs. So it's inexorable that we need to go into fiscal dominance and do as you say, add liquidity to the system, let inflation run hot, because if we approach this period of liquidity needs with a hard stop, the castle falls apart.
Absolutely, 100%. 100%. We are in fiscal dominance. We're running 7% deficit in the U.S. We have interest service that is largest than the entire defense budget, and we already have non-discretionary spending that exceeds all the federal government tax receipts. So there's no way out. It's just not a matter of opinion, or no one likes to be in this situation. No one will have desired to be in this situation. Of course, we will have desired a more prudent and responsible management of the fiscal accounts in the past. But given where we are at now, the government cannot pay its debts without higher inflation, and the companies cannot refund its or refinance its debt without plenty of liquidity. And we cannot fund all the massive increase in investing. Remember that current account equals savings, national savings, which is public savings, and in this case negative, plus private savings minus investments. So doesn't matter what you do with the tariffs. If you leave savings constant because the budget deficit is not coming down and the U.S. consumer is not planning to dramatically increase its spending, especially when you have the boomers in their golden years spending what they saved before, and then you have this massive investing boom, the current account deficit is going to come more negative. And I can already imagine the Bloomberg headline saying, "Oh, the Trump tariffs failed and the current account increased." Of course. I mean, that's nonsense. If you increase investments, national investments, because of all this data center build, the current account deficit is going to become more negative, right? Therefore, you necessarily need to issue more IOUs to the rest of the world.
Yeah.
And that's inescapable. The only way you make the burden of the old IOUs less painful is to inflate them away. And we're not saying 15% inflation, but we need 7, 8, 6, 7. my son is going to be laughing now at 6, 7. You know this 6, 7 thing, right? That's going. Okay. So so it's inescapable. So predictions: US dollar is going down. Gold is going to continue going up. I like silver a lot, and I didn't ask you what you think, but I like silver even better than gold.
Well, I'll tell you, the most money I've made on any investment this year has been on silver. Silver miners, I knocked the cover off the ball. Got very lucky, found a special situation that we discussed a long time ago. It was something that I had very deep knowledge of, that's why I've never mentioned it, because if you didn't have the domain expertise, it wasn't recommendable, but it went up multiples and ended up being
Yeah, but
But
I never, I didn't follow your advice, and I don't regret it
no,
because I'm happy. I'm happy not to make money on things I can't understand. I'm very happy that you made so much money. I enjoy your wealth vicariously, so I'm as happy as if it was my money. But for the listeners, you don't have to be waiting for like junior miners opportunities or idiosyncratic opportunities as the one in which you made like 3 or 4 times your money. But you can buy SIL silver. You can buy the Sprots ETF. Opinion and advice. We're not advising anyone to do this. It's just we're just saying that we like that thesis a lot for all the reasons that we discussed. And you can still have a diversified portfolio of very respectable silver. You can buy. I also own PAAS, right?
yeah,
Which
American
is one of the
silver.
Pan American Silver. I have a position on them, and I own a few other small companies that I'm not even going to talk about for the same reasons you didn't. But they're being very profitable for us. The only thing for me with silver, it was a very tiny position. So even though it had these huge returns, it doesn't really make a huge dent or improvement in my portfolio because it was relatively small, especially compared with the gold miners. I
Yeah,
mean,
but
we
I
discussed
tell you,
Equinox and
for
Calibre
our
and
listeners, I think the miners ETF, the silver miners ETF, is a very good alternative uh,
yeah.
because we think I personally think that silver is going to continue to outperform. Uh, in silver, we have not only is it a monetary metal, if you will, but the uses in technology are going to be increasing exponentially because silver is, I don't, many people don't know this, but
The perfect
the
conductor, right?
perfect conductor. Every conductor is measured against silver, which is the reference.
Yeah.
So
It's a gold standard
yeah,
in,
it's the
in conductivity.
pun intended. So I
Yeah.
see a lot of future uses, industrial uses, technical tech uses for silver, and the supply
Yeah.
has been dwindling. We've been running, I think, in the last few years,
Decimated. There's been,
billion ounces.
I was reading, decimated. There hasn't been new, like substantial silver developments in the last 15 years.
Well, the last mining company where I was the CFO, we had a project in southern Peru, $700 million in capex. With current prices, it's got to have an NPV of close to 2 billion. Yet nobody, the I think the company just was sold um, for a pittance of what the NPV is, but God
Hmm.
knows if they'll get it, and it's fully permitted. It's
Hmm.
fully permitted, ready to go. So it kind of also shows that in mining, things move at a snail's pace. So, and I
Yes.
think demand is going to move at a much quicker pace. So, I
Yes.
think, and the same goes for copper as well.
Yeah. Yeah. Copper. I like copper. Better than I have in the sense that confidence level, even though it cannot be as parabolic, I have a higher confidence level because I think demand for copper is going to be like a straight line, and silver is going to have ebbs and
Yeah.
flows, and it's going to be a roller coaster. But it's going to if you look over 5, 7, 10 years, if you have that time horizon, you're going to see it's moving from the bottom left to the upper right. So the next page that we have here is exactly associated with that. Is for the first time since 1996, foreign central banks own more gold than treasuries. And actually, I think that this is underestimated because we don't really know how much gold the Chinese have truly bought, how much the Russians have truly bought, and how much the Saudis, because the Saudis are not going to come out and advertise that they've been dumping treasuries to buy gold. So it's very likely that this number is significantly
Well,
different.
in the prior two
And people,
cases, China is the biggest gold producer in the world. So what they
mhm,
produce stays in China.
yeah,
They also import and refine. lead and zinc concentrates with which come with silver, and they have now said that the silver that is an output of the refining process, they're going to restrict sales and exports. So they also want to keep the silver. And Russia produces a fair amount of gold, which I assume also stays within their borders. It's refined and stays there. But yeah, the Middle East is certainly buying, and you said it before. We're gonna What we're gonna do in fiscal dominance is run inflation hotter for longer. Um,
Yeah.
that is going to decimate bond values. So this basically is the reason why we are seeing this chart, this pattern.
Yeah, and because you know this, and I know this, and all the holders of treasuries outside the U.S. know this, and those who are within the U.S. know this, and they know that we know that we know that they know,
Right.
and this is common knowledge. No one or few people are going to be holding treasuries unless they're forced to, and the more they realize that the U.S. needs higher inflation, the more they're going to shorten at least the durations of the duration of the holdings, the more Besant or whomever is the Treasury Secretary will have to do twist operations, the more the Fed is going to monetize in the short end to keep the rates at the policy level, the more expansion of the federal balance sheets, the more emission of monetary base and M1 and M2, the more the US dollar is going to come down with higher inflation. All of this is just a reinforcing feedback loop that is going to improve the odds of metals and hard assets, and is going to diminish the prospects of anything that is denominated in nominal US dollars. So, you know, it's just a matter of time, and I think this is unraveling right now. This was the year in which this started, and it's going to continue. I wanna make a point that we discussed earlier because I wanna bring it home. What you have in the top left is the Kelly betting formula. So the Kelly criterion or the Kelly principle. This is something that was very dear to Charlie's heart, and what the Kelly formula tells us is what is the optimal size of a gambling bet, size in terms of how much of our wealth we need to put behind the wager, depending on the edge that we have. Edge is the expected value of the bet, and the odds, which means how much we get paid. 1-to-1 odds means that we get 100%, right? So we bet one and we get two back. An odd of 0.5 is with 50 cents per every dollar that we bet. So the Kelly formula was developed by a mathematician who liked to play poker and gamble, and it's meant for one single bet that happen repeatedly, right? If you want to optimize your geometric return, and the edge is your expected value, and the letter E, which is the probability of winning times the odds plus 1 minus 1 divided by the odds. What happens with an investment, a single investment? Let's say you are investing in Palantir, right? And then you win a ton of money. Before the price went up, your expected value was dramatically higher than after the stock went up, right? Because the trees don't grow to the sky. So the E comes down because the P comes down. So the distribution changes, and the probability of you having a good outcome comes down. And at the same time that happens, the odds, which means the payoff if you win, are dramatically lower because the convexity is already realized. The good outcome already happened to a great extent. And when those two things happens, the F, which is the E over B, collapses. And I put an example on the bottom right. If you, before the run up, you have 60% chance of winning, you have 100% upside potential. So your odds were 1-to-1. Your expected value was 20%, and your F was 20%. Kelly formula would recommend that you put 20% of your wealth behind Palantir. Right? After a huge convex realization as it happened, because the stock went up 6-7 times, much more than 100%. Let's say that the probability of winning only went down 5%, just 5%. I think it went down dramatically more than that, but let's say it went down 5% to 0.55. Let's say that the odds went from 1 to 0.2. The Kelly formula tells you that right now it's negative. That means you will need to put a negative proportion, 170% short on Palantir. So only because of optimal mathematical optimization in betting, when you're faced with a realized convex outcome, you should reduce your exposure to that wager. That's the way Jane Street operates. That's the way Citadel Securities operates. That's the way Renaissance operates. That's the way Susquehanna operates. That's the way Goldman Sachs proprietary trading desk and Morgan Stanley's proprietary desks and JP Morgan's proprietary desk operates. These guys are optimizing via mathematical models, and trust us, they have the best mathematicians in the world calibrating and optimizing their models, and they're seeing that their Kelly formula waging has changed. That's one part of the story. The other part of the story is something that we've been discussing before, which is the expected return over a long time period, and you can prove this mathematically, is whatever is the expected return of the assets minus 1/2 of the volatility. So the volatility puts a drag on your portfolio. When you have a portfolio that is diversified in, let's say, 100 securities, the individual volatility of each of those securities doesn't impose any drag in your portfolio because you are fully diversified. But when one of those positions that were it used to represent 1/100th of your portfolio becomes 15% of your portfolio, that's not true anymore. And when you're optimizing intertemporally, that 15% of your portfolio introduces sigma, introduces variance, introduces dispersion to your portfolio. And that's what's called the Jensen Flip. Something that used to be convex becomes concave. And if you optimize your portfolio, you need to reduce the exposure. So at some point, I wonder, is the Kelly criterion related to the Jensen Flip? And those are completely two different effects. Mm-hmm. The Kelly criterion applies to an individual asset. It's something that is intrinsic to the edge and the odds of an individual asset or security. The Jensen Flip happens in the context of the overall portfolio. It's an effect of an asset becoming too large and introducing risk to an overall portfolio. So when many assets in your portfolio have a shrinkage in their F from the Kelly criterion, have an increase in the Jensen Flip, those two things compound. Those two things add to each other. So we're not saying that this is going to manifest in the market tomorrow or next week. We're saying that this is why, full circle, the microstructure of the market is dramatically riskier than it used to be, simply because of the concentration that the market has today versus the concentration that the market had, let's say, a few years ago. And that's why we jokingly, created this theorem that Paul and I discussed, in which we prove that when you have concentration, it's very likely that we're in a bubble. We let our viewers to go through the proof of the theorem on their own. But again, we wanted to close the year with this warning, because many of our viewers are people that we like and we love, and we want them to not be trapped in what we think is an inevitable unraveling of the price ebullience that we've seen in the last few years.
Another great show.
Yes, another great show. And with that, my brother and my friend, I wanted to thank you for joining me in this adventure. It's been a lot of fun, a lot of work. I think just being forced to espouse our thinking makes us better thinkers, because when you have to explain your ideas, you really need to force yourself to be clear and to be straightforward. and that's I think no one benefits more from doing this than ourselves. And of course, it's a joy to do it with you. I wouldn't do it with anybody else. It's truly a joy, and I wanted to wish you, your family, and everybody who is watching very Merry Christmas, Happy Hanukkah, Happy Holidays, and a very happy New Year 2026.
Yep, I echo the sentiments. It's been it's been a wonderful year doing these shows with you and contributing on our WhatsApp channel. I think um, learning is a great process, and the humility that we both try and bring to the analysis is what keeps us on edge, on the right edge, and sharpening that blade all the time. And as you said, we do this for the people we love, to try and give them some advice that we think is relevant. So let's do a lot more of these next year. And thank you very much for everything and your company and your great insights.
No, thank you. I'm the one grateful, and see you on the other side.
Okay,
Take care.
take